yeah, look forward to hearing some of the research that you guys are doing.
All right. Good morning. Good afternoon. So we have some material to cover here. My name is Greg Shore, CEO of Crystal Shore Dashboards, and I'm going to suggest we just jump right into it, and that'll also leave some time for Dean to resume his own presentation. So China upside down. This is the China equity market over the past 16 years, and it's been a very sad story, because essentially no one has made money in this market since 2007. And of course, this is one of the paradoxes of China. You've had this booming economy that has delivered absolutely zero returns in terms of their underlying stock market. There's been a complete disconnect between the booming economy and the absolute flat stock market over the past 16 years. And 16 years is a very long time. So the question is, were there any strategies that could have made money in this market over the past 16 years? I just want to double check. Can someone confirm to me that the slides are visible and that my audio is clear?
Yeah, we've got that. We've just moved on to a different tab there though, Gregory. So it was good up until then.
Okay. Now, are you going back to Dean, or are we sticking to China?
No, I think we'll carry on, Gregory.
Okay. So the question is, were there any strategies that could have made money in this market over the past 16 years?
Your slide deck is not showing there now, Gregory.
Oh,
I'm not sure
got you.
That's stopped.
Okay, thank you very much.
No problem. Fantastic.
Is this good?
Yeah, we've got that there.
Fantastic. So this brings up our very first poll, and we're just going to roll some of these polls as I work through the slide deck. So the question is, which single investment strategy would have had the best odds of generating positive returns in the China equity market over the past 16 years? Now, it can be interesting at this point in time to have a quick look at the famous SPIVA studies. Oh, that's fascinating. That's fascinating. I'm seeing the answers right now. So we have a strong majority in favor of timing the market as truly your best strategy for making money in the Chinese equity market over the past 16 years. And I'm delighted with that answer because it's actually completely in line with what we're going to be talking about today. Big surprise, but absolutely delighted. So fund managers are overwhelmingly focused on stock selection, sector selection, and country selection. Because for most fund managers, they are simply not allowed to time the market. They have to be fully invested or close to fully invested at all times. That's normally part of the mandate when you run a dedicated China equity fund or Asian equity fund. So if we want to get a quick overview of the success that professional money managers have had in running stock, sector, and country selection strategies, then the SPIVA studies give a very good snapshot, and of course it makes for very depressing readings. Now, unfortunately, S&P Dow Jones are not yet generating these numbers for dedicated China equity managers, but when we look at all the other regions of the world, of course, it makes for a very depressing region. So I think one of the conclusions we can draw here is that it's extremely difficult to outperform any market if you are running pure stock, sector, country selection strategies. In other words, it's really very hard to find the best stocks, the best sectors, and the best countries. It's incredibly difficult work, and collectively, the professional asset management industry fails in this mission. Now, this gives rise to our second poll. If you can successfully protect your asset base against downside loss, what kind of impact does this have on investment performance? So, this is once again our China equity market, including, of course, all the downside over the past 16 years. Now, we can spot downside. Oh, that's interesting. Okay, so a divided answer on the second poll here. You can see lots of periods of downside throughout the 16-year period, but there are really three big, quite massive market breakdowns, truly market crashes over this 16-year period. And they really stand out. So these are the three big downside periods over the 16-year period. And we can ask the question, well, how would this market look and how would our returns look if you could just factor out these three big downside periods? And here is the answer. And I call that a wow. For me, this is a wow. If you can just sidestep those three periods of downside over this 16-year cycle, well, the returns you would have made in this China equity market would have been absolutely extraordinary, fabulous. You go from a 0 to a 1,000% return. And I always ask myself, well, geez, if the rewards for eliminating your downside, if your rewards for sidestepping market crashes are so absolutely phenomenally huge, why aren't more money managers focused on this goal? Because the payoff is simply intergalactic. But instead, again and again and again, and we see this in the tidal wave of research that comes flowing over our desks every day and every week, everyone is looking for the best stocks, the best sectors, the best markets, the top 10 stocks, the top 10 opportunities, the best companies. It's all focused on the upside. No one is focused on the downside. But if you would focus on the downside and eliminate that downside, then your returns go interplanetary. The window of opportunity is so much bigger. It's crazy. So this is a question that has motivated us for a very long time. So what we're suggesting here is basically to turn China upside down. And instead of continuously focusing on the upside opportunities, just relentlessly focus on the downside. Because if you can avoid those sustained periods of capital loss, your returns in the market will become spectacular. In fact, we actually run a number of kind of concentrated Chinese Asian stock portfolios where we just eliminate everything that has downside. And then for the actual positions generating upside, we just do random number generation. And those randomly picked stocks are just outperforming the market by huge margins because you've eliminated the downside. So this is what we're doing. We're turning China upside down. Now, if you're going to focus on eliminating the downside, it probably makes sense to develop a risk-based strategy. If you can correctly identify those periods of time where the market has a high level of risk, then that can be the signal for avoiding sustained periods of downside. So a risk-based strategy is an extremely simple strategy to run. When the risk is high, you get out of the market, and when the risk is low, you get out of the market. And that can be the key for avoiding these periods of downside loss. But what you need now, obviously, is a very good indicator of market risk. You need a very good indicator of market risk. Now, these are the classic measures of risk that are used across the entire financial services industry. We have standard deviation, we have volatility, and of course, we have value at risk. All of these risk measures are essentially one and the same because they are all based on the dispersion of returns. They are all based on the dispersion of returns. Now, this gives rise to our third pole here. Standard deviation, volatility, value at risk. How useful are these classic risk measures for executing a successful risk management program? Let's focus on volatility. And at first blush, all right, so we got the results for our third poll here, and it's very much an overwhelmingly middle of the road answer. So they're not useless, but they're not extremely useful. They are of moderate use. Now, we would actually veer more towards the first answer of this poll. And perhaps this slide will shed light on our reasoning here. If we look at this chart, so this is a specific period of time. It's a snapshot of the China equity market between November 2007 and October 2008. The market is plunging, volatility is sky high, and what this risk measure is telling you is get the hell out of this market. So a volatility-based strategy would clearly work very well here. Volatility goes through the roof. It's telling you to just cash out of this market. And guess what? The market is crashing. So you're really saving a lot of capital here. It's fantastic. But now things become less fantastic because this is the same market, but looking 6 months earlier. A fantastic market period, a stunning rise in equity prices, volatility is even higher than what we have just seen. And what volatility is telling you here is get out of this market. So unfortunately, this is the big problem, not just with the volatility, but again, with all the classic risk measures, value at risk, standard deviation, because they're all based on the dispersion of returns. And the market is telling you to get out of the high volatility falling market, but guess what? You can have fantastic, highly volatile rising markets, and you will completely miss them. You will completely miss this upside if you are running your investment strategy on volatility. And you have the exact same problems with low volatility. Yes, indeed, you can have rising low volatility markets, but you can also have horrendous falling markets with a very low volatility that go on for incredibly long periods of time. And this is the problem here. The problem is that none of the traditional risk measures can distinguish between a rising market and a falling market. And they will flag both of them as being inherently bad or inherently good. In other words, the problem is that volatility gives you zero indication of directionality. But it's directionality, markets going down, that causes capital loss. Directionality is what you really want to get a clear picture of. You want to get a clear picture of the direction of markets. You want to have a flashing red light when the market direction is heading down. So let's look at a possible solution to this problem. We're going to stick with volatility. We're looking at the exact same market segment here in China between March 2007 and October 2008. But what we're going to do now is, instead of just looking at one factor, volatility, we're going to build a two-factor risk model. And we're going to bring rate of change into the equation. And look how these numbers stack up. So we have our super high volatility readings in both the rising and the falling market. But notice how the average rate of change, and rate of change, of course, is a momentum indicator, is completely different in the rising and the falling market, as one would expect, actually. And if you combine that with volatility, you're getting a much better view of what's happening here. Actually, there is no problem with a high volatility market if it's associated with a positive rate of change. But if you have the same high volatility number with a negative rate of change, then clearly you are in the danger zone. You're losing a lot of capital very fast. So this very simple two-factor model of risk is going to give you a much better picture of the directionality of the China equity market than volatility on its own. And that really is the key to understanding our own risk data. Because what we have done is we have built a picture of the risk of the market that works not across one or two factor, but that brings in 24 independent financial factors. So we're drawing on 24 financial factors: volatility, value at risk, Sharpe ratio, rate of change, relative strength indicators, extrinsic valuation, intrinsic valuation. And by bringing in all of these financial factors into the picture, you get a much deeper, richer view of the risk of the market. And it's a picture of the risk of the market that accounts for directionality. It gives you a picture of the direction, the future direction of the market. So we take these independent financial factors, we connect them with hundreds of underlying algorithms. We code this all into our computers. Now, this is work we've been doing for over 10 years, many generations of system development, but we've been running these systems now for 7.5 years. And the risk data that we generate every week has a 7.5-year track record now in China and in all the other Asian emerging markets. So this is what we're delivering. It's this continuous stream of risk data, and the data is binary: 0, 100, high risk, low risk. Either there is a high probability of losing capital going forward, or there is a low probability. of losing capital going forward. In one case, we recommend zero exposure to the market. In the other case, the low risk, we are comfortable with 100% exposure to the market. And this binary data, of course, is extremely easy to integrate into either a quantitative or a fundamental investment process. So we're delivering binary risk scores every week. We're covering China, we're covering 34 emerging countries, the 5 big emerging market regions. We're running this risk data on 1,200 single stocks and 44 commodity markets, because I saw there was some interesting commodity markets earlier on in this webinar. So the final question here to wrap up our talk is, how effective is this risk data? And here we'll just look at two pictures. So again, this is not a backtesting exercise. These are the real system deliveries. The real system deliveries that we are generating every week. And this is our risk data on the China equity market. And the flat blue lines you see in this chart are the periods of time where our risk data is flashing red, saying, get out of the market, go cash. And then we re-engage in the market when the risk is low. So again, it's a pure risk-based strategy drawing on our high risk, low risk data. And you can see the return generated. So it's been this is from 2015. We launched these systems on 1st July 2015, running them up to this week. So it's a 7.5-year period. It's been a horrible period for the Chinese equity market, down 34%. But if you are just systematically executing this risk strategy, you would have had a 6% return. So in this case, we're looking at 40% outperformance of the China equity market over 7.5 years. And this brings us to the final picture here. And it's the same risk data, but now it's running on a single stock. So JD.com, one of the biggest Chinese companies. It's the same weekly binary risk data that we are generating. Again, the flat blue line shows you when we are exiting the stock and then we re-engage. So JD.com has lost these systems. The single stock systems were launched at the beginning of last year, January 2022. So we've been running them for just over 1 year. So over the past year, JD.com has lost 28% of its value. Our risk data on JD.com has generated a 43% return just by being cash during the periods of falling values and then re-engaging when the risk was low. So these are massive performance differentials, but it's amazing. It's amazing what data can do. It's a data-driven world, and that's why we brought up this final poll, which very much with Neudata in mind here, since this is their business. And it's nice to see that that actually we do have superior data analytics winning this fourth and final poll. So with that being said, I have no idea where I am with the time. I hope I've kept this to 20 minutes and that Pankaj can now reconnect and finish his own work here at a leisurely pace. But big thanks to having you all on board, and obviously delighted to look at some of this stuff in greater detail on a one-on-one basis. Many thanks, and thank you, Neudata. Thank you, Dean, for making this all possible.
Super, no problem at all, Gregory, and thank you very much for coming along.